we will show you the best technique to combine multiple time frames to get a well-informed analysis. By combining price action and smart money concepts, we will demonstrate how to effectively make a top-down analysis. To identify the market direction, supply and demand levels, liquidity zones, and trading opportunities from higher timeframe to lower timeframe. So guys, if this is something that you are interested in, please hit the like button to show your support and subscribe to our channel. So what is top-down analysis? Top-down analysis is a technique that combines the analysis of multiple time frames and market factors to gain a comprehensive understanding of market conditions. Starting from higher time frames and zooming into lower details allows us to get a major view of market direction in key areas at all levels, but remember, starting from the monthly time frame, applying every single concept out there will make your chart look like this when you reach your entry time frame, which is completely useless. This video will teach you what to exactly look for in each of the time frames to make a well-educated analysis of any chart easily. But first, why do we even need to combine multiple time frames? Well, here are the top 3 reasons. Number 1, overcoming directional confusion. Here on the 5-minute chart, the market looks choppy without any visible direction. It continuously violates the structure levels to both up and down sides, confusing any trader trying to identify the direction. But if we zoom out to the 1-hour time frame, we can quickly identify the market trend. This area is the same area on the 5 minutes chart we were previously observing. So by knowing the higher time frame directional bias, we can take trade entries with confidence in the 5 minutes chart. Remember that whenever you were confused about the direction, and the market keeps violating the key levels of structure, you were focusing on the wrong time frame. So analyzing the bigger picture helps you to enhance your ability to take more precise and confident entries. Number 2, increasing accuracy. A minor reaction to a higher time frame key level can be a significant trend change in the lower time frame, so before placing any trade, we should check how much room we have before tapping into a higher time frame supply or demand area. This will help us understand how to set our targets, stop losses, and avoid losing trades. Here on this 15-minute chart, we had a strong bullish move with a clear fair value gap between the shadows. As a result, we have a valid order block, which is an excellent opportunity to go long. However, the market suddenly changes direction and ignores the demand order block. In case you're wondering, here's why. If we zoom out to the 1-hour time frame, we can see that this change of direction could be due to reaching a higher time frame key level that acted a strong resistance multiple times previously, so checking the higher time frame key levels could help us avoid this kind of unnecessary risks. Number 3, optimizing trade entries.
Recommended broker is Longhorn FX. It's an ECN broker dedicated to delivering a superior trading experience to traders.
Analyzing multiple time frames allows traders to identify optimal trade entry and exit points. For instance, imagine if you were waiting for the price to pull back to the order flow area and open by position to go along with the bullish momentum. If we set buy orders at the beginning of the zone, our stop will be too large. An optimal way to trade is to look for confirmation and open longs in lower time frames. This confirmation helps to get in the trades at a better price, reduces the likelihood of false signals, and increases the trader's confidence in their analysis. Now that we have discussed the importance of a multi-timeframe analysis, let me show you the best technique to combine multiple time frames to get a well-informed and clear chart analysis. Let's learn the top-down analysis technique, a step-by-step process of going through a higher time frame and scaling down to the lower details to identify best trading opportunities. We consider 3 types of time frames in our chart analysis, starting from higher time frames. First, we have weekly and daily, which we only use to identify higher time frame key levels of the market structure. Second, we use 4-hour and 1-hour time frame to do most of the analysis, including identifying market direction, supply and demand areas, order blocks, liquidity zones, and trading opportunities. Third, we will use 15 minutes and 5-minute time frames, if we needed more confirmations and entry reasons and lower details. Now let's apply these concepts on the real chart of multiple pairs to completely understand this technique. Here on the weekly time frame, in the first step, we mark the key levels of market structure that price has recently reacted to. We want to keep our analysis simple, so we only draw the most recent levels near the current price. For example, this level is our historical top, which has recently rejected the price twice. We have another key level in front of the price which has acted as support and resistance multiple times. Also, we could try another key level here. Note this is the only thing we need from the weekly time frame, which is the key levels of market structure. They have a high chance for price to react to when it taps into them. So let's zoom into the daily. On the daily time frame, first we adjust the weekly levels to get the greatest number of touches from the daily perspective. Second, we draw the daily key levels of the market structure with another color. The reason is that we want to be able to distinguish the weekly and daily levels. When we zoom into the lower time frame, the higher the time frame, the greater the importance of a level. Now this was also the only thing we needed from the daily time frame, but remember, you need to keep three things in mind when drawing the key levels of market structure. First, draw the levels where you could get the greatest number of touches. Second, drawing from the bodies of the candles has a higher priority. Third, treat the levels as areas, not solid lines. Also, there are 5 criteria that we look for when identifying key levels of market structure, and each one of them makes a level more powerful. Number 1, the turning points. Turning points are the areas that reversed the market trend previously. The market sees these areas as overvalued or oversold, and there is a higher chance for the price to reach to this levels when it reaches them again. Number 2, multiple rejections. Multiple rejections from an area shows that the traders took an action at the same level at different times, making it more powerful. More rejections are better, but it won't guarantee that the level will hold. Number 3, acted as both support and resistance. If a level of market structure acted as a support and resistance previously, it increases the probability for the price to reject this level again. Number 4, the move away from the area was drastic. Meaning that not a tiny reaction but a true reversal. The deeper the return from the level, the more important that level is. Number 5, recently respected or created levels. The recent level in front of the price are always effective since they occur anew, whether they are traditional support, resistance, or order blocks. That was all being said. Let's zoom into the 4 hours time frame to continue our analysis, which is where the smart money concepts come in. Here on the 4-hour chart, we have both weekly and daily levels visible on the chart. Each of these levels connect a strong support and resistance when the market reaches them. So we use these levels in 2 major ways. First, breaking each one into the up or down sides indicate whether the supply or demand is in control, and price can continue pushing to the next level. Second, we use them as our higher time frame targets for our trades. So the 4 hours is when we fully apply the smart money concepts, which includes identifying market direction, supply and demand areas, order blocks, fair value gaps, liquidity zones, and possible trade opportunities. So here, the market has recently broken below the key daily level with momentum, which indicates that supply is in control. Currently, we have an inefficiency move near the daily key level. The candle that created the inefficiency is our order block zone, which could give us a possible short entry, but we cannot place sell limit on this order block, since the price has rejected a key daily level, which could be a turning point for a short-term downtrend. So we need to have bearish confirmations in lower time frames like 15 minutes, to enter short positions. On the other hand, if the price breaks above both levels, it indicates a strong bullish momentum, which could make the price rise and test this weekly level one more time. Now let's zoom into the 1 hours time frame to continue our analysis. We know that higher time frame directional bias is bearish, and we expect the price to get rejected from the 4 hours time frame order block. After mitigating this daily zone, the market is making a deep retracement before reaching the 4 hours order block, which is another confirmation. Right now the price is in a short-term uptrend, and an ideal situation would be for the price to change the direction, so the 4 hours and 1 hour will be in the same bearish direction. So far we have applied price action and smart money concepts perfectly on the charts, and we have a 4 hours order block which is an area of interest for trading. It is important to note that for a 4-hour time frame order block, we look for confirmation in 15 minutes, and for the 1-hour time frame order block, we look for confirmations in 5 minutes. So here the 15 minutes chart is the last time frame we will analyze in this process. In this time frame we only look for confirmations and enter the positions, so first, we need the price to enter the order block zone and create a change of character to confirm that the short-term uptrend is over, and the market can continue pushing downward. If we see no change of character, we won't have any trade. Our first target would be this daily level in front of the price, and if the market could manage to break this area, the price can continue pushing downward to reach the next weekly level in front of the price. Now this was just an example of how to enter a trade, and you could use multiple price actions or smart money strategies to enter the market, but remember, more trades do not mean more profit.